guys, it's Stock Curry, and in today's video I'm going to show you how history is pointing towards a 2-year-long market crash. Now, I'm not telling you this to scare you, I'm telling you this to prepare you. So let's get into it! Okay, a lot of people are talking about how we are currently seeing the highest inflation since 1982. And they are looking at what happened to the stock market in 1982 and how it bottomed out and started going back up from there. And all of that is true, as you can see here on this graph. But 1982 is not really a good comparison to today because that was at the tail end of a period of high inflation. If you want to see how the stock market really reacts to high inflation, you have to go back to 1973. Towards the end of 1973, inflation was at the same level it was at today. And this was the start of high inflation period in the United States. After 1973, inflation continued to climb before finally starting to fall in 1981. So by 1982, inflation was already on its way down, the country was in a recession, and the stock market was bottoming out. But that's not what we have today. The year 1973 is a far better comparison to today because the situation in 1973 was almost identical to what we have today. In both 1973 and today, inflation was climbing. In both 1973 and today, the economy was strong. In both 1973 and today, we had just experienced 2 years of rising stock prices after a recession. In both 1973 and today, oil prices were extremely high due to supply chain disruptions. In both 1973 and today, the Fed was in the process of raising interest rates. So as you can see, 1973 was almost identical to what we have going on today. And what happened to the stock market in 1973? Well, in January 1973, the stock market topped out and then started falling. It continued to fall for 2 years through the end of 1974. Also, in November 1973, a recession started. And this year, in January, the stock market topped out and then started to fall. So if we get a repeat of 1973, which so far we are getting, then we could see the stock market fall for another 2 years through the end of 2023. We could also see a recession start in January. Now, I'm not telling you this to scare you or spread FUD. I'm telling you this so that you can get prepared. There's a couple of different ways that you can prepare for a prolonged bear market in the stock market. And one of those ways would be just to sell everything and hold cash. And that's something that Meet Kevin did. Another thing you could do would be to buy some long-term put options on the stock market in order to hedge your portfolio. That's something that the traveling trader is doing. Personally, I'm doing a mix of those two. I'm doing some put options. I'm holding a lot of cash, just holding on, preparing, hedging, waiting for the stock market to bottom out, which so far it looks like it could be a long time before it actually bottoms out. So again, don't get scared, get prepared. Now, before we get into today's news, as well as what you need to know for Tuesday, I do want to let you know that today's video is sponsored by Webull. When you sign up for Webull using my link in the description below and deposit just $1, Webull is going to send you 3 free stocks worth up to $3,300. Also, when you make your first crypto trade on Webull, Webull is going to give you $5 in free crypto. All of that is a promotion that runs through the end of February, so you only have about 2 weeks left to take advantage of that promotion. So if you're interested, you can sign up using my link in the description below. All right, let's get into today's news. Okay, the first thing I want to let you know is that CME futures are now pricing in a 40% chance of a 0.25 basis point rate hike in March and a 60% chance of a 0.5 basis rate hike in March. So now that the markets are pretty much pricing in a 0.5 basis point rate hike, the Fed should be able to do a 0.5 basis point rate hike in March without disrupting the stock market and causing a sudden drop in stock prices. Just keep in mind that in order for the market to fully price in a 0.5 basis rate point hike in March, it will need to fall a little bit further. Based upon the technicals, it looks like the S&P might fall another 3.4% before bottoming out due to a 0.5 basis point rate hike in March. I doubt the market would fall much further than that unless we get more bad news. Some things to watch out for that could cause the market to fall further than another 3.4% would be signals of a higher rate hike, such as a 0.75% rate hike in March. That could occur if we get higher than expected inflation on the next CPI report. Another thing that could cause the market to drop further would be the announcement of the Fed selling their bond assets, because that would cause bond yields to rise, which would put more downward pressure on the stock market. And another thing that could cause the market to fall further would be an inversion of the bond yields, because that would be a signal that a recession is coming soon. If we look at the 10-year Treasury minus the 2-year Treasury, an inversion occurs whenever this calculation drops below zero. And as you can see here on this chart, it happened in 2000, just before the recession of 2001. It happened again in 2006, just before the Great Recession in 2008. And it happened again in 2019, just before the market crash in 2020. Now, one thing to point out is that an inversion occurs anywhere from a few months to a year before an actual recession occurs. It should also be noted that the stock market typically starts falling before a recession starts, because the stock market is forward-looking. So if we do get an inversion, we can expect the stock market to enter a bear market within 6 months of getting the inversion. However, that's more of a longer term issue, because at the current rate of flattening, the yield curve won't invert for another 6 months. Now, we did get a little bit of good news about the Russia-Ukraine conflict on Monday. Ukraine hinted at offering concessions to avert war, and Russia's top diplomat endorsed more talks to resolve a standoff. The Kremlin also signaled that it would seek further negotiations rather than launch an immediate military action. That caused oil prices to drop a little and helped keep the stock market from falling significantly on Monday. Now, regarding what to look out for on Tuesday, we have Airbnb reporting earnings, and we also have the Producer Price Index, or PPI, coming out on Tuesday as well. Now, the PPI is another inflation gauge that might help give a little bit of clarity as far as how much the Fed might raise interest rates in March. Alright, I hope you enjoyed that video and got a lot out of it. Comment down below how you're not getting scared, but getting prepared for an upcoming bear market. And I also want to let you know that if you're interested in talking about stocks, options, crypto, the market all day long for free, I do have a free Discord that you can join. It is at stockcurry.vip/Discord. You just go over there, fill out a quick application, and you'll get an invite link to the free Discord. Now, the reason I have the application is just to help prevent scammers. Truth is, every single person who applies is going to get approved. Also, if you are looking for a broker to trade with, I want to remind you that Webull is offering 3 free stocks up to $3,300 when you sign up using my link in the description below and deposit just $1. But if you're not a U.S. resident, or if you're looking to trade OTC penny stocks, then I recommend Interactive Brokers. Interactive Brokers is a highly discounted trading platform. Trades start at just $1 US, $1 Canadian dollar, 4 euros, or 6 Australian dollars, depending upon where you live. And both Webull and Interactive Brokers both offer the full pre-market and after-hours trading from 4 a.m. until 8 p.m. Eastern Time. Now, I do want to remind you that I have material connections with both of those, so whenever you sign up for either one, not only are you getting a great broker to trade with, you're also helping me to continue to produce these great videos for you. Now, finally, I want to remind you to hit that like button, subscribe, and follow the page if you haven't already. I hope you have a lot of success trading, and I will see you tomorrow.